So in our today's session, we are going to look at company accounts. Company accounts is one of the most common areas or most common topics in exams. And it's one of the topics that carries the highest number of marks. So it's called company accounts. Now, what will we be covering in company accounts? Number one, we'll be looking at types of companies. Number two, we'll be looking at ownership of companies. Number three, we'll be looking at share capital. We'll be focusing on reserves, income tax, and in today, I'll summarize the entire IAS 12. I'll summarize also IAS 20. I'll summarize also the other small standards like inventories. There is IAS 8, accounting policies, changes in accounting estimates and errors, and provisions. I'll do the summary when I'm covering company accounts. So those standards, IAS 2, IAS 12, IAS 20, IAS 8, IAS 10, IAS 37, we'll do a summary of them in this topic today. So we'll look at also preparation of financial statements of preparation of financial statements of companies. So these preparation of financial statements of company should take half of our class today. So half of the class will be introduction to look at theory and workings of company accounts, and half of the class will also be to prepare financial statements of companies. So to start us off, what is a company? A company is any business whose ownership is in the form of shares. So if we have a business and the ownership of the business is in the form of shares, it qualifies to be a company. A company is any business whose ownership is in the form of shares. Now, we normally have two major types of companies. In this case, we have number one, private companies, and number two, public companies. So in our analysis of companies, we'll be focusing on private companies and also we'll be looking at public companies. Whether it's a public or private company, we have said ownership is in the form of shares. So that's the distinguishing factor. Ownership of a company is normally in the form of shares. Now, let's start with private companies. Now, private companies are companies who do not trade their shares in the stock exchange market, in the security exchange market. So whichever country you are, if there is a stock exchange market and the company does not trade its shares in the stock exchange market, it qualifies to be a private company. So in a private company, ownership, we have said, of companies in the form of shares. If the shares are traded in the stock exchange, it is a public company. If the shares are not traded in the stock exchange market, it is a private companies. So we are trying to say that private companies, their shares are not available to the general public. Remember, shares which are available to general public are for public companies, companies that trade their shares in the stock exchange market. Because private don't trade their shares are not available to the general public. So in private companies, some few individuals own shares. Some few individuals own shares in such companies. Now, the major distinguishing factor in private companies, at the end of the name of the private company, there is the word limited, which is normally abbreviated as LTD. So if you see any company with the letter LTD at the end of the name, you should automatically know that it is a private company. Now, these are also covered in company law. So most of you who are doing company law, I know you are familiar with this, but we need it for those who have not done company law. Now, what about public companies? We have already highlighted on public companies. So public companies are companies who trade their shares in the stock exchange market. So if a company sells its shares and buys shares in stock exchange market, if it sells its shares in the stock exchange market, in that case, it's a public company. Now, which means if it sells its shares in the stock exchange market or the securities exchange market, in this case, the shares are available to the general public. Their shares will be available to the general public. Now, at the end of the name, there is a letter PLC. At the end of the name of a public company, there is the letter PLC. What does PLC stands for? Public Limited Company. Public Limited Company. Now, there must be an initial public offer of shares for a company to change from private to public. Normally, companies just don't start trading as public companies. Most companies transition from private into public companies. Now, in financial management or managerial finance, this is normally very clear, this last point. There must be an initial public offer for a company to change from private company to public company. So today I'm going to relate the subjects you are doing. I'll be relating financial reporting to the company law, and I'll also be relating it to managerial finance or financial management. So I'll be looking at the contents of all those chapters, all those subjects or units. Now, we are trying to say in financial management or managerial finance, we are normally taught that there is what we call primary markets and there is what we call secondary markets. Primary markets and secondary markets. Now, in a primary market is where we trade shares for the first time. Now, in primary market, that is when you are trading shares for the first time. In that case, those shares are traded in what we call a primary market. Now, when you are trading for the second time, third time, selling and buying of shares, that is normally done in a secondary market. That is according to financial management or managerial finance in your context. Now, in a primary market, we can only join the primary market by offering shares for the first time. When shares are being offered for the first time through the stock exchange market, we offer it through what is called initial public offer. Now, which means a company changes from private to public company when there is what we call initial public offer. So there are three key points we have learned in public companies. Number one, public companies are companies who trade their shares in the stock exchange market. Number two, at the end of the name of the public company, there is the word Public Limited Company, PLC. And number three, their shares are available to the general public, and a company can change from private to public by going through what we call initial public offer. Ownership of companies, as we have said earlier, ownership of the company is normally in the form of shares. Ownership of companies is normally in the form of shares. And company is a business whose ownership is in the form of shares. That was our introductory statement. Now, share capital. We have said ownership of a company is in the form of shares or share capital. So what is this share capital? Share capital is basically the contribution of the owners of the company. How much the owner contributes to the company. What the owner contributes to the company is what we call share capital. Now, these shares must always be valued. These shares must always be valued. Again, let me go back to company law. In company law, there are types of share capital. Share capital can either be preference share capital or ordinary share capital. So when we look at share capital, it can either be preference share capital or it can be ordinary share capital. Now, what is preference share capital? Preference share capital have a right, or preference share capital holders have a right to a fixed rate of dividends, which means preference share capital are being paid a fixed dividend. So if it is 10% of their shares, every year they'll be paid dividends equivalent to 10% of their shares, which means the dividends they receive is fixed. Number two, they are paid first. When it comes to payment of dividends, we first of all pay preference share capital holders, and then if anything remains, what remains is now paid to ordinary share capital holders. That means they are paid first. The last point in preference share capital, they have no voting right. Preference shareholders, they don't have any voting rights in the decisions that are being made. So there are three key points. Please, let's be attentive and note that there are three key points in preference share capital. They have a right to a fixed rate of dividends. Number two, they are paid first. And number three, they have no voting right. Now, there is a point I'm going to make which is not in the slides and it's not in the notes. And take note of it. It's very important for your exams. There are, please, you can write this somewhere. There are two types of preference share capital. I know you have covered it in financial management, managerial finance, those doing it. There are two types of preference share capital. There is a reason why I'm stressing that. Number one, there is what we call redeemable preference share capital. And number two, there is what is called irredeemable preference share capital. So when we look at preference share capital, it can either be redeemable or irredeemable. Redeemable, R-E. Irredeemable, I-R. So it can either be redeemable or irredeemable. Now, irredeemable are the preference share capital that will not be bought back. In other words, you issue them and you don't have the option to buy it back. It cannot be redeemed. That is known as irredeemable preference share capital. Redeemable are the ones that are issued for a specific period of time. Maybe after 5 years, we can redeem them. We can repurchase them. Or the owner of the capital can sell it, can redeem back his money. So if I buy shares in your company and you give me preference shares, if you give me redeemable preference shares, in that case, it means I can sell back the shares after some period of time. Now, the reason why I was stressing this is the next point. Irredeemable preference shares are treated as equity. I'm repeating. Irredeemable preference shares are treated as equity in the balance sheet. Irredeemable preference shares are treated as equity in the balance sheet, and therefore dividends are paid out of them. We pay preference dividends for irredeemable. Irredeemable is the one that will not be bought back. Now, for redeemable preference shares are treated as non-current liabilities. I'm repeating, irredeemable are treated as non-current liabilities. What have I said? Redeemable. Redeemable are treated as non-current liabilities. Redeemable are treated as non-current liabilities because the shares are issued, but I have the option to sell the shares back. So it is treated like a loan. Now, for the redeemable, the return to the share capital is treated as a finance cost. I'm repeating. For redeemable, the preference dividends is treated as a finance cost because it was treated as a non-current liability, and therefore the return is treated as a finance cost. I hope I'm clear. So when you'll be seeing me preparing financial statements, there are some times I'll be treating preference share capital as equity, and there are some times I'll be treating it as non-current liabilities. When do we post it under equity? When it is irredeemable. When do we post it under non-current liabilities? When it is redeemable. Redeemable, non-current liabilities. Irredeemable, equity. Irredeemable, equity. And therefore, the return is treated as dividends. Redeemable, non-current liability. Therefore, the return is treated as a finance charge, as a finance cost. I hope that's clear. If you've understood, you can just type yes in the chat so that we move on. I hope that's a very clear distinction. So if it is redeemable, non-current liabilities, the return is a finance charge. If it is irredeemable, equity, the return is dividends. Okay, I hope it's clear. Let's move on. Okay, let's move on. Now, ordinary share capital is next. All ordinary share capitals are treated as equity. All ordinary share capital are treated as equity. But preference, we said, there are some which are equity, there are some which are non-current liabilities. All ordinary share capital are treated as equity. They are subordinate, that is the ordinary share capital. They are subordinate to the preference share capital. What does that mean by subordinate? Which means if we are to make any payment of dividends, we first of all settle the preference shareholders, and then if anything remains, that is when we settle the ordinary share capital holders. So they are settled last. That's why they are subordinate. They are only paid after the preference dividends have been paid. They have a voting right in the meetings of the business. They have a voting right in the meetings of the business. They have a voting right in the meetings of the business. I hope that's clear. So which means ordinary share capital holders, they can vote for decision making. Preference share capital holders are not allowed to vote in decision making. Classes of share capital. Let's not confuse types and classes. We have a number of classes of share capital. On the top, we have what we call authorized share capital. Let me just do some explanations, and then is when I go into details. So in a hierarchy, I hope you know what a hierarchy is. At the top, we have authorized share capital, then followed by issued share capital and unissued share capital. In other words, at the top, we have authorized share capital. Authorized share capital is divided into two. Authorized share capital is divided into two. Number one, issued share capital, and number two, unissued share capital. I'm repeating. At the top, we have authorized share capital. Authorized share capital is divided into two. Number one, issued share capital, and number two, unissued share capital. I hope you are now following the hierarchy. Now, issued share capital is again divided into two. Issued share capital is again divided into two. Called up share capital and uncalled up share capital. Called up share capital and uncalled up share capital. Called up share capital is divided into two. Paid up share capital and unpaid up share capital. Let me repeat. Authorized share capital is the share capital at the top. I will explain what it is. Authorized share capital is divided into two: issued share capital and unissued share capital. Issued share capital is divided into two: called up share capital and uncalled up share capital. Called up share capital is divided into two: paid up share capital and unpaid up share capital. So what does that mean? At the top, in the apex, there is what is called authorized share capital. So let's look at them one by one. What is authorized share capital? Authorized share capital is the amount or quantity of share capital that a company is registered to give out. The amount or quantity of share capital that a company is registered to give out, legally allowed to offer. So if we register our company with RDB, the registering body, they give us permission to have maybe 100,000 shares at 100, at a value of 100 each. So what will be the total value of share capital? It will be 100,000 shares times 100 to give you 10 million worth of share capital. So this is what is called authorized share capital, what the business is legally allowed to offer. Now we have said authorized share capital is divided into two. There is issued share capital and unissued share capital. Remember, we had given out 100,000 authorized shares at a price of 100. The value is 10 million. Now, issued share capital is the number of shares that a business has actually issued to the shareholders. Remember, authorized is what you are legally allowed to give out, but that does not mean you give out everything. So out of 100,000 shares, you may decide that even though I'm allowed to give out 100,000 shares, you decide that I will give out only 50% to enable me have a chance to give out more shares in future. So what you decide to give out to the shareholders is what is called issued share capital. So issued share capital is the one you have decided to give out. For example, out of these 100,000 shares, a business may decide to give out 50,000 shares at a price of 100, which gives you 5 million. So which means authorized share capital was 10 million. Now, out of which 5 million is issued and another 5 million is not issued. 5 million is issued and another 5 million is not issued. Now, if we go back to the issued, so issued share capital is the number of shares that a business has actually issued to the shareholders. So the businessman tells shareholders that even though I have authorized 100,000, for now, I'm going to give out only 50,000 shares, which is 50%. Now, what they have not given out is known as unissued. Now, let's go back to issued. Issued, we said that we want to issue 50,000 shares at a price of 100. But because you recognize sometimes shareholders don't have all the money they can pay at once, you ask the shareholders that even though I'm giving you 50,000 shares at a value of 100, I want you only to pay me immediately 60. For all you pay me at 60, and then the balance you'll settle in future. So even though I had issued 50,000 shares at a price of 100, you tell the shareholders that I understand you may not pay everything. So I ask you to pay 60 per share, and then in future you'll clear the balance. So what you have actually asked shareholders to pay immediately is known as called up share capital. Called up share capital is what you ask shareholders to pay immediately. So you have asked them to pay all the 50,000 shares, but at a price of 60, and then in future they will pay the remaining balance of 40. So what you ask them to pay is known as called up. What you have asked them not to pay immediately is known as uncalled up, share capital. Now you have given shareholders the option to buy immediately 60 and later on 40. But shareholders are just people. He may promise you that he will buy, but now when it comes to paying, he pays you less than what you had asked them to pay. So what the shareholders actually pay is what is known as paid up share capital. What they actually pay. What they don't pay is known as unpaid up share capital. Now, as I close on that, what is paid up share? What are the classes of share capital? We have said number 1, we have authorized share capital. Number 2, we have issued share capital. Number 3, we have unissued share capital. Number 4, we have called up share capital. Number 5, we have uncalled up share capital. Number 6, we have paid up share capital. Number 7, we have unpaid up share capital. Now, we have said ownership of shares of companies is in the form of shares. I believe we have said that. Now, how does company issue shares? How does company issue shares? We had already touched on it when we were looking at EPS. How does companies issue shares? There are 3 ways of issuing shares. You can issue shares at full market price. You can have what is known as a rights issue of shares, and you can also have what is known as a bonus issue of shares. So when you are issuing shares, there are 3 ways to issue shares. Number 1, you can issue shares at full market price. Number B, you can have what is known as a rights issue of shares. And number 3, we can have what is known as bonus issue of shares. Rights issue of shares and bonus issue of shares is issue of shares to the current shareholders, to the existing shareholders. You are not issuing any new shares to new shareholders. You are issuing new shares. You are issuing shares to existing shareholders. For example, the market price of shares can be 150. Please, let's understand this example because it's the example I'll use to explain all. So the market price of shares was maybe 150. The nominal price is 100. Let me repeat. Nominal price is the book value of the shares. Nominal price is the price which is in the balance sheet, in the statement of financial position under ordinary share capital. That value per share is normally known as nominal. Now, the market value of the shares in most cases is normally higher than the nominal value. If you were to sell your shares currently, you will not sell them at the price at which you bought them. You will not sell them at the nominal or the price at which they were issued. You will sell them at a higher rate, which is known as a market rate. So that is this first line. So suppose the market price is 150 and the nominal price is 100. In issue of shares at full market price, the business will issue the shares at 150. So when we are issuing shares at full market price, you will issue it at that price of 150. Now, issue of shares at full market price, the business will issue the shares at 150. Now, in a rights issue of shares, which is the second one, the business will issue shares to current shareholders at a price below market price, but above nominal. So in rights price, the shares are being issued at a price below 150, but the price must be above 100. So for example, we can issue at a price of 120. In that case, if shares are issued at a price below 150, for example, 120, but the price is above 100, 120 is above 100, and to the current shareholders in proportion to their current shares, that is known as rights issue of shares. What about bonus issue of shares? Bonus issue of shares is issue of new shares to the current shareholders for free. The shareholders don't pay any extra amount. In that case, it is the bonus issue of shares. In that case, it is bonus issue of shares. Bonus issue of shares to the current shareholders in proportion to their current shares. So note, normally when shares are issued, nominal value times number of shares goes to the share capital, and the market price minus the nominal goes to the share premium. Let me explain. When you issue shares at a price of 150, the nominal price is 100. For example, if you issue 1,000 shares at a price of 150, in that case, the cash received is 150,000. Now, these shares are divided into two. There is what goes to the share capital, and there is what goes to the share premium. So if you issued at 150, the nominal is 100. So you take 100, which is the nominal, times number of shares. Number of shares was 1,000. That gives you 100,000. 100,000 goes to share capital. Now, between 100 and 150, the price at which you issued, 150 minus 100 times the number of shares goes to the share premium. It goes to the share premium. Issue of shares at full market price. So we are starting, we said there are three ways at which you can issue shares. Number one, you can issue shares at full market price. Number two, you can have what is called rights issue of shares. And number three, you can have what is called bonus issue of shares. So let's start with number one, issue of shares at full market price. Issue of shares at full market price. I have already explained, if the nominal price is 100 and the market price is 150, you issue shares at the market price. In that case, we call it issue of shares at full market price. So normally, the market price is above the nominal price. We have already explained that. Nominal price times number of shares goes to share capital. We have already explained that. Market price of 150 minus nominal price of 100 times number of shares goes to the share premium. Double entry. Let us be attentive. Now, when you issue shares at full market price, you will receive some cash. So if you issued 1,000 shares at a price of 150, you will receive total cash of 150. Because cash is an asset and cash has increased, you debit the cash. Now, when you issue shares, you receive cash as a business, but you are giving out shares. You are giving out equity. So therefore, when equity increases, you credit. So there will be two equity items. There will be the share capital and there will be share premium. When you add the share capital plus the share premium, it should be equal to the total capital, total cash received. It should be equal to the total cash received. Equal to total cash received. Pascal, you are asking, explain the difference between share capital and share premium. Now, share capital is the capital account where the shares are kept at nominal price. I'm repeating, share capital is the equity account where shares are kept at nominal price. Share premium is the equity account where the difference between market price and nominal price is kept. Share premium is the equity where the difference between share capital and share premium is kept. So I hope I've explained the difference. We have an example. Let us be attentive in this example. If the nominal price per share is 100 and the market price can be 150, So 100 nominal price, market price is 150. Just the same example I've just given out. Suppose XYZ Limited issued 1,000 shares at full market price. Required, calculate the amount of share capital and share premium. So what is the cash received? Cash received is the total market price of 100 times 1,000. Sorry, 150 market price. Market price is 150, not 100. 150 times 1,000 is the total cash received. So the cash received is 150 times 1,000. That, remember, is the debit entry. Now, what goes to the capital? There will be two capitals. There will be share capital and there will be share premium. There will be share capital and share premium. The nominal price goes to the share capital and the market price minus nominal price goes to the share premium. So market price minus nominal price times, of course, the number of shares, it goes to the share premium. So you debit cash, you credit share capital, you credit share premium. What is issue of shares at full market price? It's issue of shares at full market price is issue of new shares at the prevailing market price. Double entry we have already explained. You debit cash, you credit share capital, you credit share premium. Let me see, there is a question. David, what if your debit bank and credit both here? It's okay. It's in order. If these guys deposited the money into the bank, you can debit bank and credit share capital, you credit share premium. But you see, whether the money is in bank or it is in your office, it is still cash. The difference is one is cash at bank, another one is cash in hand, but it is still cash. Now, I'm still reading questions, okay? So number B, there is what we call rights issue of shares. We had already explained it. Rights issue of shares. What is rights issue of shares? It is issue of new shares to existing shareholders in proportion to their current shares at a price below market price, but the price is above nominal price. I'm repeating. It is issue of new shares to existing shareholders in proportion to their current shares at a price below the market price, but above the nominal price. At a price below the market price, but above the nominal price. What is the double entry? Debit cash, credit share capital, and credit share premium. The same as full market price. But under share premium, you don't take market price minus nominal. You take rights price, which is normally below the market price, times the nominal. So what is rights issue of shares? It is issue of new shares to existing shareholders in proportion to their current shares at a price below market price, but above the nominal price. Okay? When they pay some in cash, Vincent, don't complicate issues. When they pay some cash in, you know, almost all payments are always through bank. Don't complicate the question. All payments nowadays, it's very difficult to get payment in cash. What I'm saying, whether it is bank or cash, it is still cash. But even if you treat it as debit bank, there is no problem. So long as there is evidence that it is either cash in hand or cash at bank, that is what we debit. These others are just they cannot issue shares through two different ways. All shares are normally issued through a bank by depositing in bank. Even in the stock exchange market, the trading is through bank accounts. We don't give physical cash. So rights issue of shares, we have already explained it. The accounting treatment is the same as full market price, but the price is at a rights price instead of market price. I have an example. Let's understand this example. Let's make sure we understand it so that we move. So remember, we are in a rights issue of shares. Rights issue of shares. So if the nominal price per share is 100 and the market price is 150, the current number of shares is 10,000. Suppose the current number of shares is 10,000. Suppose XYZ Limited issues, please, this is important. Remember, the nominal price is 100, the market price is 150. The current number of shares is 10,000. Suppose XYZ Limited issued 1 new share for every 2 held. So the company issued 1 new share for every 2 held at a rights price of 120. 120 is below 150 and it is above 100. Required, calculate the amount of share capital and share premium. Fred, sir, can it be possible to issue shares below nominal price? It rarely does that happen. But remember, there is what we call a bonus issue of shares, which is issue of shares for free. But even if shares are issued for free, they are given a value and they are given a nominal price value. They are given a nominal price value. So the answer is no. I hope Jocelyn have explained to you that. Oh, no, that was not Jocelyn's question. Jocelyn is asking, can you sell shares at a loss? You'd rather not sell shares if you will earn a loss. You'd rather not sell shares if you will get a loss. Now, we have this question. Again, let me read it. There was interruption with those questions. If the nominal price of shares is 100 and the market price is 150, the current number of shares is 10,000. Suppose XYZ Limited issued 1 new share for every 2 shares held at a rights price of 120. So the price at which the shares have been issued is 120. So calculate the amount of share capital and share premium. New rights shares, what are the number of shares, new shares? Remember, we were issuing 1 new share for every 2 shares. So which means the current shares is 10,000. The new shares will be 10,000 times 1 divided by 2 because the ratio was 1 for every 2. So you will take the current number of shares, which is 10,000. You multiply by 1, you divide by 2 to give the new number of shares. So our new number of shares is 5,000 because you have taken 10,000 times 1 divided by 2 to give us 5,000 new shares. Now, these new shares are what will be issued at the rights price of 120. So you take 120 times the new shares to give you 600,000. 600,000 is the cash you will receive. 600,000 is the cash you will receive. So share capital will therefore be, remember we said in the share capital, we transfer at nominal price. Share capital will be at the nominal price. So 100 times the 5,000 shares, but remember to give you 500,000, remember the rights price was 120. So you take 120 minus nominal times 5,000, that goes to the share premium. The double entry therefore is the total cash received, which is 120 times 5,000 to give you 600,000. And then you credit share capital at nominal price, and you credit share premium as the difference between rights price and nominal price. Finally, the third category of issue of shares is issue of shares to existing shareholders in proportion to their current shares for free. That is known as bonus issue of shares. So when you issue new shares for free, you issue new shares to existing shareholders in proportion to their current shares for free. In that case, we call it bonus issue of shares. But even if issue of shares is for free, no cash is received, but we must post a certain amount in the balance sheet. the amount that is posted is nominal price. So we post at nominal price, but there is no cash received. We post at nominal price, but there is no cash received. Now, shares, bonus shares are normally, because there is no cash received, they are normally issued from share premium account. I'm repeating. If there is any bonus to be issued, they are issued from the share premium account. If there is any bonus to be issued, they are issued from the share premium account. They are issued from the share premium, unless you have been told it is being issued from any other reserve. If you have been told it is being issued from retained earnings, deduct it from retained earnings. If you have been told they are being issued from general reserve, deduct it from general reserve. Otherwise, they are always issued out of share premium account. Because there is no cash received, and assuming they are issued out of share premium will reduce. So you debit share premium and you credit share capital. You debit share premium and you credit share capital. You debit share premium and you credit share capital. Jean, what is meaning of one new share for every two? Now, Jean, how can I explain to you that? Gad, I think I had explained nominal price when we started. Mugisha, I had explained nominal price is the book value of the shares. Nominal price is the book value of the shares. The price at which shares were given out for the first time and the price at which the share capital is recorded in the balance sheet. Now, that is Gad. Jean, meaning of one new share for every two. Now, how can I re-explain that? Let's go back to that question. So suppose XYZ Limited issued one new share for every two. It's just like that. They gave out one share for every two shares they have. In other words, this company XYZ has got 10,000 shares currently. Now they want to raise more shares. They want to have more shares. So they issue one share for every two existing shares. So for every two shares the company has out of 10,000, they issue one new share. They issue one new share. Okay, let's continue. Thank you for stating that you have understood. Thank you. Is it Emma or Emmanuel? Okay, thank you. So I hope you've understood that. So let's go to bonus. Now we have said bonus is issue of shares for free. So in a bonus, there is no cash received. Because there is no cash received, this bonus must be removed from a certain account and taken to the share capital. We normally remove it from share premium. Therefore, share premium reduces. When share premium reduces, we debit. And we normally take it to share capital. Share capital increases with credit. And we value bonus shares at nominal. When you are giving the value to bonus shares, you give a value at nominal price, even though there is no cash received. We have an example. Let's follow it before I give you a short break. If the nominal price per share is 100 and the market price can be 150, the current number of shares is 10,000. Suppose XYZ Limited issued one new share for every two held for free. Because it is issued for free, no cash is received. Because it is issued for free, it is a bonus issue. Required. Calculate the amount of share capital and share premium. So note, bonus is financed from share premium account, but if you have been told it is financed from retained earnings, you finance it from retained earnings. And therefore, share premium will reduce because we financed it through the share premium. So share premium will reduce and share capital increases. And we have said we value them at nominal price. So you take 10,000 times 1 divided by 2 because it was 1 for every 2. to give you 5,000 shares. And then you get the value, nominal price times 5,000 to give you 500,000. And you debit share premium. Why do we debit share premium? Can somebody respond to me in the chat? Why do we debit share premium? Response in the chat. Vincent. Vincent, in bonus, okay, the chats are too many because you are answering my question, but let me talk to Vincent first. In bonus share capital, if you don't pay cash, you pay through your existing retained earnings or reserves. Vincent, your statement is not correct. Bonus issue, we don't receive any cash. We don't receive any cash. Yet double entry must be there. Therefore, we issue out of premium account and it's taken to share capital, removed from premium and taken to share capital. However, I have said, if you have been told it is being issued out of retained earnings, you issue it out of retained earnings and you take it to share capital. You debit retained earnings and credit share capital. Thank you. Thank you now. It is okay. I had asked, why do we debit the share premium? Because it is reduced. Thank you. That is the answer. Because it is what? Reduced. When share premium reduces, we debit. Thank you. Thank you, everyone. I'm seeing we are understanding what we are covering. So that's good. And that's what we have done here. And that allows us to have some short break. So let's have some short break.